Hey, welcome back to Two Super Guys Trade Stocks. I am Dylan.
And I'm Vinny.
And we're going to take kind of a look at a video that Everything Money did, and Vinny would probably agree with, but I very much disagree with. And we're going to see his reaction because this kind of goes against value investing as a whole.
Ooh, love it.
Two Stupid Guys Trade Stocks.
All right. Now, what I said goes against value investing. Just hear me out before you make some assumptions here. Okay?
Fair enough.
So this is the... What's up?
I'll say I haven't seen this video. I haven't watched them since the whole Seth debacle, in fairness, okay? But so I just want to kind of give that background. I used to be a fan, but after that whole Seth thing, I kind of stopped watching them. So I don't know what this video in particular is about.
Yeah, I agree. Seth was the best part. That was a bummer. So honestly, the video doesn't matter. I'm not even going to show a clip of it. It's just, what's his name? Is his name Paul?
Paul. Yeah.
Paul saying,
Yeah.
hey, market's overvalued. He uses a SPY to GDP, and he shows, look at the ratio. This is crazy. And then he said, this is just like the irrational exuberance thing that we're going to talk about. But basically, he's just saying, look, right now, it's not worth buying anything. Years from now, I may be saying buy, right? And the years from now kind of seems interesting, all right? Because when we put this stuff into a time frame, let's say most people are in the market for 40 years. Just go with that. Like you start at 25,
life,
65. Yeah. Okay. These value investing plays of don't buy, wait for a better price actually does not hold up to history. Okay. You actually would have lost a crap ton of money had you followed that rule. All right.
Okay.
You still with me?
Yeah, no, I completely am with you. Yeah, you can't really time the markets. Time in the market, right? That's like
exactly
the wisdom of index fund investing and dollar cost averaging. Yeah, I get that.
Right. So December 5th, 1996, the market has irrational exuberance, meaning the market optimism lacks real foundation of fundamental valuation, but instead is just all psychological factors, right? So this is the .com bubble, okay? Meaning, I know I did quotes. It had gone up for like 3 years, like crazy, right?
Yeah.
And then Jerome Powell at the time, same position at the time.
This is a young Alan Greenspan here.
Yeah, this is a young Alan Greenspan. Was like, guys, this is insane. What's going on here? Okay, he said that December 5th, 1966.
1996.
1996, thank you. Let's just look at some things here. Okay?
Yeah, we got 5 more years of this massive bull run before anything actually comes crashing down.
Wonder where I'm going with this. But let's look at the crash, too, because this is after you have 6 years of insane gains, right?
Yeah.
Now, this little mark where I put it is September 1996. I wanted you to kind of be able to see. Can you see my arrow?
Yeah.
You can see he says it. There's a tiny little dip here. People are like, oh my gosh, what is he saying? Right? Okay. So that's the Dow. Okay. Now, here's the SPY. I'm going to move your face. You see this yellow line all the way off to the screen? Okay.
Yeah.
That's the date that he said this speech.
So yeah.
Okay.
This goes down as like the guys that say the internet wasn't really going to change the world. Basically, level of poor calls. Yeah, I understand.
Yeah, interesting. So he says that at that line. Then there's 4 years of Paul saying, "Guys, this is crazy. Guys, don't buy. This is insane. This is there's just no deals in the market." Right? Okay. Well, let's see what would have happened. Now, let's say this is super zoomed out. This goes all the way to like 2015. Let me move my face. Yeah, SPY 2013. Okay. So if you're Paul, your argument is we have irrational exuberance, don't go in the market. And then had you bought on 3 specific perfect days, 6 years later, you would have the same price cost averaged as the irrational exuberance speech.
Wow.
The exact same price. So he's kind of being like, yeah, all these guys are idiots going up until 2001, right? And look at all the deals you have from 2000 to 2004. You don't have any deals. That's not accurate. The chart doesn't lie.
Yeah, it's pretty fascinating. It's kind of like the Gen X dividend investor guy. I haven't followed him too much recently, but he talked about how he had a friend that was like, the market is just overvalued in like 2016. He sold his entire portfolio, and as of the last time he mentioned it was like maybe 2020, 2021, this person still hadn't bought back in. It had been 5 years of gain since then.
Yeah.
Probably 70% plus on the SPY appreciation of that time period, and this person was still waiting for the crash. So I get it.
Make any sense. Now, I'm going to point to the argument that people will be probably typing in the comments right now on how I'm wrong. And I am wrong on one part. I'm going to point that out. So here's Amazon before the craziness, 80 cents. At the craziness, $5.80, relatively soon, right? And then they drop all the way back down to 80. Okay? That's a big drop. But, I mean, grand scheme of things, who cares?
Yeah.
Okay? Now, here's the argument where they're like, well, Dylan, what if you invested in companies that were not super profitable? I mean, we're profitable, but we're part of the bubble. All right? This is Vinny's baby. You invest at right above Vinny's face here at about the speech. Goes from $17 up to $75, back to $17. And then the good argument against is we're still not back. And it's been 22 years. Now there's dividends.
Don't forget, there was a 5% dividend yield for a long period of this time. So you did probably get some cash flow. You'd have to go back and calculate that in. But yeah, 100%. Still not a winner.
Still not a winner. Now, the argument is, hey, the SPY ratio is already very high, okay? And we're probably not 4 years away from the crash. We could be a lot closer. It could be tomorrow. I've already done a video on this, but the conditions are so different because the amount of money we have created, the amount of people in the market, because of the ease of access, you're no longer paying $100 a trade like you used to. It's now free. It just doesn't quite relate. This is actually from that presentation. 10% of the daily trading volume of the biggest stocks are retail investors. That number was 1% in the dot-com bubble.
Fair enough. And then we have a lot of dumb money that just buys index funds now too. So market prices don't really move as fluidly as they probably should, right? All the gains go to the top few companies because of that index fund convention, buying constantly. I get it. And it's interesting from like a valuation perspective. There are charts that correlate the PE ratio with the real 10-year return. And at the point we're at right now, I want to say that our real 10-year return is like a negative 4%, and somewhere along those lines. If you look at that kind of correlational chart, correlation is not causation, but it gives you an idea of what to expect. So I don't know. I'm torn on my opinion of timing the market sometimes.
Yeah, I just look, if you are leaving the market in the next 5 years, then okay, then Paul's strategy may be great. If you're not, it's terrible. It doesn't make any sense there's no good deals right now. Dude, just put 20% of your income every year and just buy. It doesn't matter. Just go for it.
20% in Alibaba stock. That's a good deal.
That to me it is, but he didn't touch on that. Well, I don't keep up with all his videos. But let us know what you guys think. I just thought it was really interesting because he said in the video the irrational exuberance speech, and he's like, look what happened then. So then I went to the chart and was like, well,
what did happen then?
Because it dipped right back down to the speech. So unless you timed it perfectly, I don't know. All right, guys.
Catch you next one.